When you have rental real estate, it's not subject to self-employment tax. So you're really saving between 7 and 15%. If you qualify for this real estate professional status, you would be able to offset that passive loss against some of your active income. I've heard crazy things like I had an accountant tell a client that they should stick a for rent sign in the ground and then they can claim it as a rental property. Real estate has a lot of just inherent tax benefits that we kind of take it for granted. So those are the two biggest opportunities for tax savings by just owning rental real estate.
All right. Welcome to another episode of the Agent to Investor podcast, where we talk about the agent side of real estate investing. We talk about the successes, the failures, and all in between. My name is Nico Garcia, local real estate agent and investor based out of Montgomery County, Maryland. And as always, I'm joined by my co-host,
Anna Bilek, Northern Virginia realtor and mostly out-of-state investor.
And today we have another awesome, wonderful guest. We have Danielle Rutigliano. Welcome to the show.
Thank you so much for having me. I'm really excited to talk with you both.
And I hope I did your last name justice.
Yes, you did.
All right.
Not an easy one.
And we are super excited to have Danielle on. She is a real estate investor herself. She is a certified CPA, actually my CPA. So we wanted to bring her on, especially with all these changes going on with the tax laws and things going on in politics. We wanted to bring her on, talk about the tax side of real estate investing, not just for investors, but also agents, a few different topics that we'll go into. But before we go into that, do you mind giving a quick introduction of where you're from and what initially got you into the real estate space?
Yes, absolutely. So I am a CPA firm owner, virtual CPA firm owner, and I'm also a real estate investor myself. I'm based in Babylon, New York, so Long Island, New York. We're outside the city by about an hour, so people usually like that as a point. I am a real estate investor, and I mostly own out-of-state real estate investments at this point. I love to invest in everything from short-term rentals to long-term rentals, single family to small multifamily properties. I've done a little bit of everything in the real estate space, so I'd love to share with you guys more about that. I'm very passionate as an investor, and as a business owner, I like to support small business owners, especially in the real estate space. So I have a lot of agents that I work with, and real estate landlords, and really everything in between.
So talk to us how you got into the real estate space. I know it sounds like you've done a ton in the investing side, but what initially brought you?
So I love to talk about my real estate journey because I'm mostly talking to my clients about their real estate duties and accounting and taxes. But it's really nice to also talk about being a real estate investor too. So I started in my real estate investing journey when I was in my early 20s. I was spending a lot of years just renting properties as a tenant. And I realized at some point I didn't want to pay landlords help pay mortgages anymore. I wanted to switch places. So I was lucky enough when I was 25 to find my first house, which is a duplex in the area. And I was able to successfully house hack, which really got me into that real taste and kind of hook on real estate investing. Because after doing the math and after moving the tenants in the one unit and having a roommate in my unit at the time as a single 25-year-old, I realized at that point that I had completely eliminated my housing costs at that point. So it was really nice to have absolutely no mortgage or rent to pay for anymore, and it allowed me to have a lot of freedom. So fast forward a couple of years, my roommate moved out. I met my future husband and we moved into his house. We kept my house as a rental, and we got to the point with my house as a rental where it had a lot of equity because it had appreciated a ton. That was a really good time in the market. And it had appreciated a ton. And me and my husband were getting into it and thinking what we could do with all that equity. And we decided that we could do more with that equity than what that property could ever produce for us as a rental. So what we did was we took a big risk and we ended up selling that house and turning that equity into 2 short-term rentals in Tennessee. So we had absolutely no experience with really out-of-state investing. We took a big chance on it and it ended up working out really well. We had 2 partners involved with us with those short-term rentals, but it was a really fun, throw yourself into real estate investing, learn as you go. We self-managed the properties. We went to go check on them a couple of times a year. It was a really fun and great experience that really got us into real estate investing. And then we also had some really good success with those rental properties appreciating in the Smokies because it was around like that 2018 timeframe. And the same thing, the same question proposed itself. Like, we had so much equity in those properties. We thought, what is our best use of that equity? And what can we do with it? Can we snowball this into more rental property? So we ultimately, that's exactly what we did. We refinanced them, both of that, after owning them for 2 years, pulled a good amount of equity, and we were able to do a bunch of different things with them. 6 or 7 years later, we ended up selling those properties eventually, but we do have about 8 regular rentals in Indiana. So in the Chicago suburbs, we ended up there because it's very landlord friendly. We got connected with some really good property managers in the area, so the investment was much more passive for us. We also have a portfolio of multifamily properties in the South Bend area. Right now, that's where we are. We also have a duplex in Rochester, New York, which I really like that area too. And me and my brother also have a family portfolio that we kind of work with and have brought a really long way in the middle of all this. And that was another really great learning experience. We ended up finding out that we had a family portfolio that was in very distressed condition, all New York. So we had to get really creative, and I really credit that experience as giving me a lot of my real estate investing knowledge, because we had to get really creative and flip a couple of the properties and then reinvest the money into the remainder properties, because there were about 8 properties that were in very poor condition that we had to figure out whether we were going to keep them, sell them, and really clean up and recycle the funds throughout them to continue to maintain and keep some of them as really good rental properties. So over the course of about 3 years, we took this portfolio from being completely distressed to this very stabilized multifamily portfolio with Section 8 tenants that's guaranteed income, which is really nice in New York, where it's a little less landlord friendly. So I learned a lot through major construction projects. We had houses that were leaning deeply on one side, on second stories. We had a porch that was supporting somebody built a second story off of a porch foundation. We had crazy things. Like, there were major foundational issues, and it was some major projects that you would never take on unless you had to. If you went to go buy those kind of properties, you would have always walked away. But because we had them already, we kind of had to come up with solutions. And that really gave me, and my brother as well, some really good foundation and kind of a little bit more guts to invest in some other things that are a little bit scarier for other people.
Okay. So at what point during your investing journey did you become a CPA? Were you a CPA at the beginning? Was it somewhere in the middle? And then at what point did you decide to dive into making it real estate specific? Because not all CPAs know the real estate.
So I've always been a CPA. I did work for bigger accounting firms. I worked for a top 15 accounting firm, and I did have a lot of real estate clients that I worked on a very big basis. As I started to go through my real estate journey, I was getting a little burnt out at the public accounting firms, where there were a lot of really long hours and a lot of less control over my schedule. I had plans on growing our family and stuff like that, and that became really hard. So I would say around like 2020, the wheels started to spin. And that's when I really started to go off on my own to start to take on some more clients. And then I officially took the full-time leap in around 2022, I believe, to go full-time, real estate specific, working for myself with a small team in the accounting space.
I think it's really cool that you shared all that background of what brought you into the real estate space to begin with, and then using that as a tool, because real estate investing is, like you just mentioned, there's short-term rentals, there's real estate agents, there's some fix and flips, there's so many different ways. And having a partner, just like an investor-friendly agent, having an investor-friendly CPA can save you thousands in taxes and things like that. So it's cool having that experience and then eventually using it as your own business.
Yes, it was great. And there was definitely a need for it as I was working through it on my own, or having friends in the industry and working them through some problems before I officially went off on my own. I just said to myself, like, there really is a need for this. Like, most CPAs don't speak the real estate investor lingo. When somebody talks about a sub 2 or a midterm rental or an MTR, using all the abbreviations, like, I know exactly what they're talking about. Not only, and there's also some interpretation, obviously, that needs to go into the IRS code in other different kind of positions, but having that background in also being an investor really helps interpret that better.
Yeah.
What I'd love to do, and there's so many different ways where we can go in this discussion, and I want to just start with what is one of the main benefits being a real estate investor, even if it's like a side gig. I'm assuming there's a ton of tax incentives, right? Then yeah.
Yeah, there are. I always like to remind not only clients but just taxpayers in general. Real estate has a lot of just inherent tax benefits that we take for granted. For one, you get to really have income that's considered passive in the eyes of the IRS. The IRS likes that you are providing housing for individuals. There are a lot of tax advantages. There are a lot of deductions that you can take against that rental income. They really it's just more beneficial that way. For example, rental income is considered passive income instead of active income. So your regular W-2 or real estate agent income, or just your regular active businesses, that's all subject to your regular income tax at your federal and state level, but also it's subject to self-employment tax or payroll tax if you're a W-2 employee. So there's a whole separate kind of tax structure. If you're a W-2 employee, you would recognize that as FICA. If you're a self-employed individual, it's called self-employment tax. It's all the same thing. But there's a whole separate tax component to active income. When you have rental real estate, it's not subject to self-employment tax. So you're really saving between 7 and 15%, depending on if you're a W-2 employee or you're self-employed. You're already off the bat taking that off the table. So that's just something that we take for granted because we just forget about that. But that is a major tax advantage. Secondarily, you get almost a non-cash deduction for owning property that's called depreciation. So you are getting a deduction worth the value of your property less its land component. You do have to carve out a land component. You're able to take a deduction over time that is deducted against your income. So it's reducing your taxable income by just purchasing the property. And what's really great about that is you didn't spend likely the full purchase price in cash to get that deduction. Likely you put down a down payment, right? So say on a $100,000 property, you put down 20%, but you will get the majority of that purchase price as a deduction, even though you only put $20,000 down. So it's essentially, there's a big component of that's a non-cash outlay. So you get a really big benefit that way. So those are the two biggest, just off the bat, opportunities for tax savings by just owning rental real estate. You can get even a little crazier with it as far as depreciation goes, and we can go into some other different kind of tax planning strategies that can accelerate some of that depreciation, make it even better. You have the opportunity to defer taxable capital gains by buying other rental properties and using a function of bonus depreciation to reduce that taxable income. You're also, if you hold rental properties long term, you get a more tax advantageous capital gain rate versus if you're buying properties or you're, holding investment short term. So you do have some other tax advantages that way. So you have a lot of big benefits for real estate that people aren't even considering.
Okay. So as a real estate agent, I think we check this box, but I think there is a box where people need to either work so many hours on their investment property. Like how can someone take advantage of these tax benefits? I know one is a real estate status, which we have, but what if you're a W-2 employee that just happens to have a rental property? Can you take advantage of all of these things?
Yeah, so great question. So yes, the things that I was just talking about is just our basic tax savings. So meaning if you have a ton of rental income, you can pretty much reduce all of that through some of those functions. We can take that a step further if you're a real estate agent, because you could potentially qualify for something called real estate professional status, which would bring that to an even more advantageous step. So essentially that means if you have excess losses, so you reduced your income past zero, meaning your expenses are higher than your income. If you qualify for this real estate professional status, you would be able to offset that passive loss against some of your active income. So typically, without being a real estate agent or having a short-term rental, which we'll get into in a second, where you're talking about who, with the W-2, who can benefit from that. But if you're just a regular landlord with maybe a W-2 or something like that, you would be able to really just get your taxable income to zero. If you're getting past that, for those individuals, that excess loss would be carried forward indefinitely until they needed it, meaning they had taxable income in future years. If you qualify for real estate professional status, though, you can start to unlock some of those losses and not have them suspended. They would be offset against your active income in that given year. So ways you can qualify for real estate professional status is if you spend 750 hours and more than any other non-real estate activity in a given year. Real estate agents that own rental properties, that makes it really easy because your day-to-day job is in the real estate space. So those hours would count towards that. Plus your hours that you're working on your rental properties would count. So real estate agents, it's very easy to achieve that. This next secondary step is that you would also need to qualify for reps. You'd also need to materially participate in your rental properties. So meaning you really couldn't, unless you had so many that you'd be able to quantify it, you'd really want to make sure that you're actively managing your rental properties as well as part of your day-to-day, because you do also need to materially participate in those activities. So that, for all real estate agents, that is surprisingly something that's missed by some CPAs who are not specific in real estate or they don't ask the right questions. But that is your most tax advantageous strategy, especially if you're working in the real estate space and owning rental properties. You can also qualify for reps if you're not a real estate agent, but you work in other areas of real estate, like you're a contractor. Or if you have a couple and, one of the individuals has a W-2 job or just works as a typical W-2, and the secondary person really manages a whole portfolio of rental properties, you can still reach that 750 hours. So it's really a great tax strategy, especially for real estate agents, but really anybody who's working in the real estate space or has a good amount of rental properties. So I'd say once you have 3 or more rental properties, even if you're not a, real estate agent, you could still really be spending a lot of time managing those properties. You just have to make sure that you're fulfilling that more than anything else component. So if you have a part-time job, you can have a part-time job and work 750 hours in real estate. You just have to make sure you don't work more than 750 hours in that part-time job. So you want to make sure you're spending more time in real estate than anywhere else. So if you're spending 1,000 hours in a part-time job during the year, you have to spend 1,200 hours in real estate. So you have to make sure that your real estate is more. So it's not just 750 hours. It has to be and more than any other activity.
Okay. All right. And then I've been told many times, keep a Google Calendar, do something because if the IRS ever comes asking for receipts, if I have a Google Calendar showing this is my appointment with the property manager, with the tenant, with this, with that, and the other, that's good enough, at least in that regard, to show like, look, these are the hours I'm working. Is that accurate?
So it's a good step. What they would really want to see is a time log. So having something that is a report or an Excel spreadsheet, or there are some apps out there, they're always changing. So I don't remember one off the top of my head, but there are, having a true log and listing is the best option. A calendar would help you figure out what you were working on to create that log. So it's definitely a good start. But you want to try to have that log in place because that's really what they're going to be looking for. So what's important to have on that log is the hours that you're spending, a description of the task, a date that you're working on that task. So it's very important to have the description and the hours and the date in the log. Because what they like to do is look at your description and see if it's within reason. A couple of things while we're on that topic to be careful of and what qualifies for hours and which hours count. In most cases, anything operationally necessary to run your business is most likely going to count. You obviously want to work with your tax professional based on your individual situation to really get the right answer for your particular situation. But most likely anything operationally that you are doing in your rental property business or your real estate agent business would likely count. Some areas that are a little bit more, left for judgment or travel hours, I recommend to clients not to use travel hours to get you to that 750. Still track them, but it's an area that is left open for some judgment. It's an area that they'd like to pick apart in an audit. So some areas like that, you definitely don't want to put any kind of fluffing time in there. Anything that's unreasonable is something that they're going to look at and pick apart. So anything that's operationally necessary for your business is a good general rule of thumb to use when tracking hours.
Okay. Sounds like I need an app. Oh.
The apps definitely help, yeah, to keep you a little bit more organized and to have that report.
Nico, do you have an app that you use for this?
I need to get on that. I have my Google Calendar as well, but on my homework right now.
Yes, of course I keep track of this. Every IRS agent that's listening, I have all the documentation. Period. The
To
end.
edit this one out.
Yeah, for real.
The other thing just to note while we're on that topic is you want to also make sure some people get a little bit confused. You have to be working for yourself to have those hours. So if you're a W-2 employee that works in the real estate space, those hours don't count. You have to be the owner of your business or a 1099 contractor, or you're the landlord of your properties. So like working as a W-2 for a property manager wouldn't count unless you own the property management company. So just another thing to note while we're on the topic.
That actually brings me to my next question. So I know you mentioned real estate professional status has a ton of benefits in the tax world. I think you mentioned contractor, definitely agents that own real estate can benefit from it. But what are some other field, or does it really matter of how many hours they have? Like the property managers and things like that also qualify for real estate?
Yeah. So property managers also count. Contractors also count. Managing your own portfolio of properties. Some people have 5, 10, 50 properties. That's a business in and of itself.
So what is your advice for somebody like a real estate agent that doesn't own rental properties? They're not essentially really getting the huge benefits that the real estate professional status has, right?
Yeah.
And they're paying lots of taxes.
Yeah.
And they're paying lots of taxes. So my recommendation would be find a way to get some rental properties. If you don't have a lot of funds to put up front, maybe even considering getting a partner involved on a deal to maybe bring the cash, then you would only get 50% or whatever your ownership percentages are of those losses on that property, but it would still be better than nothing. Or get creative. A lot of real estate investors in the space get creative with sub-2 deals or seller finance or a low down payment option. Because even if you're putting zero money down, you're still getting the tax benefits of owning that real estate and that rental property.
Yeah. And this is the plug for the importance of a CPA in the real estate space as an agent, because not only like are you doing our taxes, but then we get on phone with you if we're smart and we strategize long term. Like, this is how much income I've made. This is how much time is left in the year. What can I do to lessen my tax burden? This is a partnership if you find the right person to do it with, like Danielle.
Exactly. So real estate agents, what their biggest challenge is that you guys make really good commissions and don't have that many expenses to really help you reduce that income. So that's really why owning rental properties really helps you out. So you really need a lot of tax planning as a real estate agent because of those reasons. You don't have a lot of overhead. You don't have a lot of capital expenditures that you have to purchase. You have a lot of income, and that's a good problem, right? You have a lot of good net income. It's just, it's something you have to plan for so you don't get hit over the head with taxes.
Yeah.
So Danielle, you touched on this earlier, and I wanted to circle back, is depreciation and how you can use depreciation as a tool for tax benefit. But you also mentioned bonus depreciation. And I know there's been some changes in, the big, beautiful tax bill and things like that. So what is bonus depreciation, and how could somebody use that for their benefit?
So in the most basic sense, depreciation, like I mentioned a little bit earlier, is a mostly non-cash deduction that the IRS allows you to take depending on what type of property you purchased. If you purchase a regular rental property, it's considered a residential property, and you're able to take that deduction over 27 and a half years. If it's a commercial property or a short-term rental, because short-term rentals are considered commercial properties, you would take those deductions over 39 years. That's the most basic sense. If you are doing work to a property yourself after you own it, meaning you're making some kind of improvement to that property, some of that property, since you know the details and the scope of work because you're doing it yourself to the property, some of those may fall into a tax life that's shorter than that 27 and a half years or 39 years. For example, land improvements, the IRS says you can take the depreciation over 15 years. Furniture and fixtures, you could take over 5 or 7 years, depending on the type of furniture or fixture it is. So what bonus depreciation is, it's an accelerated depreciation component that allows you to accelerate depreciation on property that falls in buckets less than 20 years. So any of those property, like furniture and fixtures, land improvements, anything outside of anything less than 20 years, anything that falls in that less than 20-year bucket, you would be able to qualify for bonus depreciation. So that means depending on the tax year and the rules currently, because it's something that was ever changing up until this recent tax bill. For 2025, before this tax bill, we were on track to allow a 40% bonus depreciation deduction. So what that means is if you had spent $20,000 or let's say $100,000 on land improvements, you would be able to take 40% of that up front in the year that you place that asset in service, and then the rest would be over that 15-year allotted bucket. Under this new recent bill, that changed to 100%. So you can accelerate all of the cost of that depreciation. So it's very tax advantageous for individuals like yourself who can qualify for real estate professional status, because it does create a very large loss up front. It does create a future potential tax problem, but it can really create a great tax benefit up front. And when I say a future tax problem, it's an opportunity for tax planning in the future. It doesn't necessarily have to be a problem, but it is something that you have to consider in the future, because you are accelerating all your depreciation up front. So that means you'll have less of an expense in future years. But for individuals like yourselves who have real estate professional status, they're real estate agents, and they want to continue to build wealth through buying real estate, it's like a snowball effect that you can fix each year. Creating that kind of accelerated bonus depreciation each year would allow you to have a lot of deductions up front to reduce your income and create some other really good benefits.
Now, in order to qualify for this bonus depreciation, do you need to do a cost segregation study to figure out the lifespan of all these?
So great question. So the example I had just used is if you were owning the property and then doing the work yourself. So the scope of work, you're working with the contractor, you know exactly what you're doing. But another way you can use bonus depreciation is on that initial purchase price. So the IRS assumes, without having anything else done, that you have to depreciate it over 27 and a half years or that 39-year period. But if you have an expert come in and go through the details of that property through something called a cost segregation study, he or she would be able to allocate all of the components that you actually purchased. And it may not just be over a 27 and a half year period. They may say there's a sprinkler system here, or there's kitchen cabinets, and all of those components, if allocated differently, will fall into different live buckets. So essentially, once you get that finalized report, that cost segregation expert will have carved out all of your components. So you'll have not just one bucket that's being depreciated, but maybe 5 different buckets. And anything, again, less that falls into those buckets that are less than 20 years would be eligible for bonus depreciation and you could get a deduction in that current year for that. A couple of things to consider with that is cost segregation studies can cost a good amount of money. So it's something that you want to always talk with your tax professional about to see if it's beneficial for you, because what a lot of people do is they'll hear it on social media, get a cost segregation study, and they may not be getting the benefit from it. So they may spend $3,000-$4,000 on a cost segregation study and maybe get $500 back in their tax return, which is not a good return on their investment. So you want to make sure you're really tax planning with your tax professional to have a really good idea of whether it's beneficial for you. In most cases, if you're a real estate agent and you own rental property and you have some really good real estate agent net income on that side of the business, it likely wouldn't hurt to have a cost segregation study done on a property that you purchased, but it's something that you want to work with your tax professional on. The other thing to consider is that depending on the purchase price of the property, you may also not get a good result. So if you bought a property for $100,000, they may charge you $2,000, and it may not be enough accelerated bonus depreciation to really get you a good return on your investment in the study.
Yeah. And I think if you buy it for $100,000, you might have mentioned this earlier, but my understanding is you also have to, like you said, there's a land component. So you may have paid $100,000, but maybe $40,000 of that is the land value, which doesn't fall into this depreciation bucket.
Yes. So it's another thing to consider. So I usually say, as a general rule of thumb, it obviously varies. If your purchase price is less than $300,000, it sometimes isn't. I would say in most cases it's not beneficial, depending on your overall situation. There have been some cases I've worked with clients that had lower purchase prices. Maybe they had 3 or 4 units and they had duplicate kitchens and LVP flooring and other stuff that really it did become beneficial. But I would say a general rule of thumb, if it's under $300,000, a cost segregation study may not be worth it.
Okay. All right. And then, like you were saying, for future tax planning, I guess not the downfall, but the flip side of depreciation is unless you have a strategy when you go to sell the property, if you go to sell the property, you essentially have to pay that back in some way, shape, or form in taxes. So that's where strategy comes in the future.
Yep, exactly. Great point. So you want to consider and you want to handle this strategy carefully. It can be extremely powerful. It could result in saving you a ton in tax. If done the wrong way, though, it could also create some problems for you in the future, especially if you want to sell a property. So you always want to handle this strategy as a general rule of thumb with property you plan on keeping for a while or a long term. There's ways to, if you had to get out of an investment that you took bonus depreciation on, there are band-aids you can put in place, like doing a 1031 exchange to avoid some of that. But yes, you would be hit with something called depreciation recapture tax if you were to sell that property, which is essentially would, like you said, be forcing you to pay some of it back. So you want to be really careful and strategic about how you're doing this. But it is a very powerful strategy for somebody who is in your situation and looking to build their rental portfolio at the same time.
Danielle, can we actually chat about, I know this is an advanced strategy, but the 1031 exchange can be super beneficial for somebody that's actively buying rental properties and maybe trying to scale up. How does that look? Maybe like the 101 of 1031 exchanges.
Yeah. So a 1031 exchange is a good strategy. Right now, it's a little bit hard because of the market. So I don't see a lot of them being overly successful right now because you are limited in the amount of time that you have to close on that secondary property. So what a 1031 exchange is, it's a like-kind exchange. So essentially, you want to get out of one rental property and you want to replace it with a similar asset. So similar rental real estate. You would be able to do so and defer some of your taxable gains at that time into a future period when you sold that next property, if you met the criteria of the 1031 exchange rules with the IRS. So you have a certain period to identify those next properties, and then you have to close on a property that you identified from that list. So it's a little bit hard in this market. The overall 1031 exchange has to be completed within 6 months. So from the time that you're identifying the property, close on the initial property, and close on the secondary one, it has to be done in 6 months. So it is a little bit hard in this market. Again, something you should talk to your tax professional on to see if it's the best opportunity. But it is definitely something that is possible to do to help you. And it doesn't eliminate the gain that you would have on that property, but it would defer it into a future period. So you wouldn't have to pay tax on it at that time if you did complete the exchange. You would need to work with somebody called a qualified intermediary. If you were doing that, this is another mistake I do see, so I like to mention this. You want to make sure that qualified intermediary is involved before that first property closes to be sold. The cash proceeds cannot cross your account. So a lot of people reach out to me and say, I sold my house, I have all this money, I want to do a 1031 exchange. And at that point, unfortunately, it's too late. You can't do it then. Once you've touched the cash, you're not able to do a 1031 exchange at that point. So you have to get a qualified intermediary involved who is essentially just a middleman who's going to help you facilitate the 1031 exchange.
Okay. It's definitely an advanced strategy, but you can use it with any property proceeds and things like that you're looking to defer to the future. But I want to chat a little bit about, so my fix and flippers that are listening, and I know there's 2 different buckets. If you sell the property within a year versus in the future, you mind talking about what that looks like in terms of your net proceeds and what's being taxed if you do it at a certain time versus a different time?
Yes, absolutely. No, I will talk about this too. So real estate agents and fix and flip investors, you're both in the same bucket. So we can knock off two birds at one stone. So fix and flip investors and real estate agent income is all in the active income bucket. So it's not, you don't get the same kind of benefits as we were talking about with rental real estate. So fix and flip investors do not get the benefits of depreciation. You can't depreciate fix and flip properties. Fix and flip properties or investors, in the eyes of the IRS, they really consider them holders and resellers of inventory. So your houses at that point are an asset that you're holding and then reselling. Similar to a car. dealer. If you were buying cars and reselling them, very similar concept. So your net income that you earn as a fix and flip investor is subject to your regular income tax and that self-employment tax that we were talking about earlier. So that payroll tax or self-employment tax. If it's your own business, that self-employment tax rate would be 15.3%. So on top of your income, your federal income tax rate and your state income tax rate, you would be subject to that 15.3% tax rate on that net income. So there are some opportunities for tax planning to eliminate or reduce that 15.3%. In a lot of cases, if you're making a good amount of income, for both real estate agents, real estate brokers, and fix and flip investors, going the C Corp route can be a good opportunity because a C Corporation is a tax election that allows you to plan and lower the amount of self-employment tax that you have to pay.
Okay, so I'm an S Corp, so I don't know what that means in all of this. Is that the same as a C Corp? I don't actually know that answer.
So an S Corp is very different than a C Corp. An S Corp is meant for, it's okay, close enough. You have one, you're in the right direction. So an S Corp is meant for small businesses. It is very tax advantageous. You are supposed to pay yourself a reasonable salary through a W-2. So like you're an employee of your company. You pay that payroll tax on your W-2 income, but anything that you pay yourself outside of that W-2 income, that's considered just distributions.
Yep.
You do not have to pay that 15.3% on. So you're really saving a good amount on that remaining income that you're paying yourself. What you want to be careful with is just that you're paying yourself a reasonable salary. So you want to use market data and some other factors, the amount of hours you're putting in to really consider what you're paying yourself to make sure that's supportable with the IRS.
Yes, it's good that only like 1% of agents sell the most houses because that brings that salary to. I may or may not have looked into this already. So I don't know if Nico has more questions on that side because I was going to ask because people always ask me about capital gains and I don't know how that ties in, if it does to fix and flips or just capital gains in general. People ask me about those. If I'm going to go sell this, what is capital gains? What does that mean? What am I going to have to pay?
Yeah, so capital gains is, in the eyes of real estate, is mostly when you're talking about rental properties. Fix and flip investors typically are short-term projects. They're getting in and out. All of that is taxed at your ordinary income rate. Long-term assets held long-term are sold at long-term capital gains rates. So rental properties, if you sell them after a couple of years, that would be subject to your capital gains tax rates.
Is there, like you say, long-term? What's the definition? Because I know there's some people out there that are super nerdy that like numbers. Is that 12 months? It's been a year. It's been in service for a year. What is that threshold? Or is it fungible?
Great question. Yes. If it's in service for a year, it's considered a long-term for capital gains.
Which means it's been rented for a year, not that you've held it for a year.
Correct. Yes.
Okay.
Yes. In that case, it should be in a business that's been in service or a rental property that's been in service for a year to be on the safer side. That's what I would typically recommend.
So those who are fix and flip investors, would you say there's benefits to being both, like holding some long-term and holding some as fix and flips?
Yeah, it would, because it's the same situation as a real estate agent. So if you're being a fix and flip investor, it's a very lucrative business. You're likely making good net income, and then you have good net income that you have to tax plan for. So you can still qualify for real estate professional status through your work as a contractor. And then you have to just really plan for your rental properties and how you're buying them to help reduce some of that income through the rental properties. Yeah. And what's also great is the fix and flip investors and the real estate agents typically have a lot of properties that come across their plate. So they can really choose which ones they want to keep, which ones they want to flip, and then some. Where they run into some issues is just the ones that they think they're going to keep and then they end up selling, or vice versa, if they're flipping it. And then they ended up keeping it. You just want to make sure that you can prove that. If you're in the business for flipping properties, you want them and you decide to keep it as a rental, or if your intention was to keep it for a rental, but then you ended up selling it and you're also in the business of doing that, you want to just make sure if you're trying to reach those capital gain rates, you want to make sure you can really prove that your intention was to keep it as a rental property. So meaning you had it listed, maybe you had a tenant and it failed. You want to really be able to support that. I've seen some bad tax advice where they tell you, I've heard crazy things like, I had an accountant tell a client that they should stick a for rent sign in the ground, and then they can claim it as a rental property that they were selling, even though they never had a tenant in. You want to be careful. The IRS is not, they can see through that kind of stuff. You don't want to get yourself into trouble like that, especially if you're in the business of fixing and flipping. It's much harder to do that. You want to make sure that your true intention, you have to essentially prove intent for it to be a rental. So you want to make sure that you're really honest and you have the support for that.
Yeah.
You don't
Last
want to
thing
be
you want is
shady.
the IRS's attention. I was going to say, once they see you and they're like, ooh, you're shady, we're going to keep looking at you.
That's the last thing you
Yes,
need.
exactly.
Danielle, I know talked a little about all the tax changes with this new law, and there's a bunch through a bunch of different things, but I want to talk specifically about real estate. We talked about the bonus to depreciation, but was there any other new things in this legislation that real estate agents and investors should keep an eye on?
Yeah, so I'll talk about a couple of my favorite ones that have come up. So yes, for one, 100% bonus depreciation is back. That is the number one that's going to have the biggest impact. It was originally on track to completely phase out. This change in this bill did make it a permanent change. So it is no longer, it's not like they created a program that's going to phase out again. As of right now, it is going to be a permanent change until there's a change in presidency, and there could be a potential bill in the future that creates a change. But as of right now, based on this bill, if this bill stays in place, it will obviously through the whole presidency, that will stay in effect on a permanent basis. So that's a really good thing about that. The threshold to file 1099s raised as part of this bill. So this is a really fun one too, because nobody likes 1099s. So just to kind of give everybody a summary, if they're not familiar with this, when you're paying vendors as part of any kind of business, whether it's rental real estate, a real estate agent who has an assistant, or a fix and flip investor who's paying other contractors or subcontractors, you're required to file with the 1099 rule and comply with the 1099 rules. So what that means is you have to evaluate all your vendors. You should be getting Form W-9s filled out by all your vendors, which basically just fills out all their information. And then you should be using those W-9s to evaluate whether you have to send them a 1099 and file a 1099 with the IRS on an annual basis. That's something that's due at the end of January each year for the previous tax year. And it's something that is always forgotten. It's done last minute. It's always, everybody is guilty of this. It's always something that's a big pain in the neck. So originally the threshold was $600. So any vendors that you're paying $600 or more to, you would have to evaluate to file 1099s. As of 2026, this bill is changing that up to $2,000. So beginning in 2026, that is something that is going to be a change. So that's a big change. It could eliminate a lot of those smaller payments that you're sending to vendors. So that's a big change. Another one is the QBI deduction. This is something that a lot of people aren't aware of. So it's a qualified business income deduction. It's Section 199A. Some people hear of it from that perspective, not to get too technical. Essentially, it's a haircut on your business income that was in place. So at the end of the day, whatever you calculated as your net taxable income, if you were a qualified service business, you may be eligible for this additional just 20% haircut at the end of your net income. As part of this bill, that is also remaining permanent. So that's staying. So that was something that we were concerned about or changing, but it's going to stay at 20%. So in most cases, real estate agents would qualify for that. Some landlords would qualify for that. So that's a really good, nice little haircut at the end of your tax bill that comes off if you have qualified business income. The last thing I just wanted to mention was the SALT, the state and local tax cap. So originally or previously, it was capped at $10,000. So for people who own real estate as a primary residence in states like California or New York, where you have really high property taxes, you weren't really getting that benefit, and it was most likely forcing you to not itemize and take the standard deduction. That cap was raised from 10 to 40,000. So it's a much bigger gap. So it's going to cause a lot of taxpayers to likely be able to get that higher itemized deduction now. So that is something that is being put in place, and it is temporary. So that does start to phase out a little bit or make some changes after 5 years. But as of right now, it is going for the next 5 years, it's going to be in place at that $40,000 cap. So
Ooh.
say if you own primary real estate that has, and you have $20,000 of taxes, it's going to help you or add to your itemized deductions.
I like that one because there was a point where I was like, we're not getting all the advantages of our deductions because that $10,000 cap, it was like, damn it.
Yes, that hurt a lot of people in California and New York and the high property tax states, including myself in New York.
Yeah, the DC area is probably up there with it too. I have a quick question about one of those four, the 1099. You
Yeah.
said that you have to not investigate, but evaluate whether or not the vendor needs a 1099. What is there a quick and dirty rule for someone to know, like whether you need to send a 1099 or not? What is that determining factor?
Yeah, the 1099 rules are unnecessarily complicated. The short answer is that if you're paying a corporation or an S corp, they're immediately not going to need a 1099. That's just what the rules state. Then the next thing you have to evaluate is if you're paying an individual, an LLC tax as a partnership, or an individual or an LLC tax as a sole proprietor, then you have to then evaluate how you're paying them. If you're paying them through credit card, through a third-party credit card or payment processor, you likely don't have to send them a 1099. If you're paying them through bank ACH, or you're paying them through check, or if you're paying them sometimes through a Venmo or a Zelle, in some of those cases, you would need to send them a 1099 if you met that $2,000 threshold beginning in 2026. So this is only applicable for the 2026 tax year, not 2025, but that's it. So you have to first evaluate the type of business they are, and then how you're paying them and how much you're paying them.
Wow, this is choose your own adventure. Is this where someone goes to a tax professional and says, these are the vendors? Or do I just go like this and be like, I think I'll pay this one. I think I did a 1099 over here.
So some people like to be a little risky and try to figure it out on their own.
Okay.
Some clients like for us to just deal with it for them, which we do for clients that are interested in that.
Okay.
So yeah, unless you're really excited to read through all the 1099 tax rules that change every year, I would advise having somebody who is familiar with it to do it, because the penalties for not filing them can be around $600 per unfiled form. And if they decide that you were deliberately unfiling them, they can pretty much go back with no statute of limitations and charge you for each form that was not. They could also disallow expenses that you're claiming on your income in previous years if you don't file them. So it's no joke, the 1099s. It's something that is overlooked, but it is a bit of a serious filing that people should take seriously because the penalties are pretty high.
Yeah. I think that's one people don't pay attention to. I think you're right. And it sounds like it can totally screw you over if you don't do it right.
It can. Yes, it is. It is something that can come back to bite you.
And that's why it's important to have a professional CPA on your team. Make sure you're doing tax planning throughout the year.
Yeah.
And that way, at the end of the year, you're not hit with all these penalties and boatloads of things you weren't really expecting come tax season.
And sometimes even if you have a really good bookkeeper, not even just a CPA, some really good bookkeepers are also very familiar with 1099s and could help you with that filing. But yes, CPA is definitely going to be your safest bet as far as filing.
Okay. And speaking of which, so we are running low on time, but this has been super informative. I know there's probably a lot of people that learned a few things, probably have a few other questions. Yeah. First of all, are you accepting you and your team accepting new clients moving forward, whether they're agents, whether they're investors?
Yes, we're definitely accepting tax consulting clients and bookkeeping clients right now. We do have a current wait list for tax preparation clients at this time, but we're happy to have tax consultations with anybody who is working with another CPA or has any tax questions or do their own taxes, or just somebody who is looking to be set straight in the right direction when it comes to planning and entity structuring, anything to that nature.
Okay. And where can they reach out to you and your team, Danielle?
So they can reach out to us at our website at www.reiaccountingadvisors.com.
Awesome. And we'll make sure to put the show note, your link. But that is going to do it for another episode of the Agent to Investor podcast. Please share, subscribe if you found any value, and then reach out to me or Anna. You can reach out to me at N Garcia Official on all social platforms, and you can reach out to Anna at
I'm Anna Bilic _realtor on Instagram and just Anna Bilic everywhere else. And as Danielle said, you can reach her at her website because I don't think she wants all of you inboxing her with all these tax questions. Just
Website.
website.
Thank you, Danielle, and tune in to the next one.
Thank you so much.
Thank you.